Thank you very much for that generous introduction. My parents are no more. I wish they were here. My father would have been proud of what you said. My mother would have believed it. The most frequently asked question of me is, when is the crisis going to be over for India? Over the last 1.5 years that I've been at the Reserve Bank, I have practiced and refined an answer which goes approximately as follows. I took office as the governor on the 5th of September 2008. Fannie and Freddie happened on the 6th of September. Lehman Brothers collapsed on the 15th of September. AIG happened on the 18th of September. So people get the drift that I brought on the crisis. So I tell them when my term is going to end so that they know, they can correlate and find when the crisis is going to be over. Okay. This is the pleasant and unpleasant surprises about the India growth story. Before the crisis, people were surprised that we had clocked such growth. In the 5 years to 2008, India clocked growth of 9% per annum. And before the crisis, or much before that, we had internalized the fact that India is stuck in a low growth syndrome. So when we got 9% growth, it surprised a lot of people. Then in the years before the crisis, we were fed on the decoupling theory, which said that because our policy framework has improved, because our foreign exchange reserves are more robust, because our growth is driven by domestic factors, the crisis cannot affect us. So the ferocity with which the crisis hit India surprised many people. Then after the crisis, the big question is, when do we get back, or when do we get onto the double-digit growth? Last fiscal, 2009-10, the year that ended March 31, 2010, estimates are that India had grown between 7.2 to 7.5%. As the economist said, people are raising estimates of growth in the years forward in indecent haste. The higher the growth you project, the more patriotic you are. That's the way that's going. Okay. I want to first answer 4 questions. Why was India hit by the crisis? How was India hit by the crisis? How did we respond to the crisis? I will get through them reasonably fast and then spend some time talking about what's the outlook for India. On the first question about why was India hit by the crisis, there is dismay on 2 counts that India was in fact hit by the crisis. The first dismay came from the fact that people said this is a financial sector crisis, but you're shouting from the rooftop saying that the Indian financial sector is safe and sound. Our banking system had no exposure to the subprime assets. The Indian financial sector had limited off-balance sheet activities of securitized assets. So how come a crisis which had origins in the financial sector affect India? The second cause for dismay was the fact that the export sector, exports constitute only 15% of India's GDP. So people are saying, how come there is surely a global recession, but how can a country which depends so little on the external sector be affected by a crisis like this? We were affected because we are more closely integrated with the rest of the world than we care to acknowledge. People compare between the Asian crisis of the late 90s and today, the recent crisis. But at the time of the Asian crisis, we were not so integrated, and today we are much more integrated into the rest of the world. How do we say that? We say that from these numbers. If you look at the composition of the two-way trade as a proportion of GDP in the 10-year period between 98-99 and 2008-9, that ratio of exports and imports as a proportion of GDP had roughly doubled. But if you take the two-way current and capital flows, that has more than doubled in the 10-year period. What that says is that India's trade integration has got deeper, but India's financial integration was even deeper. And that's why we were affected by the crisis. I have some numbers here, but I won't go through them. Perhaps if there's time, I will address that issue with some numbers later. So, having answered the first question, why was India hit by the crisis? Now let me turn to the second question about how was India hit by the crisis. And we were hit through all the channels and through a story that is by now quite familiar. We were hit through the financial channel, the real channel, and the confidence channel. First, on the financial channel. All our financial markets, our money markets, our debt markets, our credit markets, our foreign exchange markets, our equity markets, they were all affected by the crisis. They all came under pressure. And that again is a familiar story. First, Indian corporates in the years before the crisis were accessing external markets because they found that rates of interest in the world markets were lower than in the Indian markets. So corporates who could borrow abroad were borrowing abroad. And as the crisis erupted, they found that those sources had dried up. The corporates in turn had kept their own money in mutual funds, which in turn invested in non-bank finance companies. So when the external sources dried up, they came back and started accessing their own money, which was left there, which put pressure on mutual fund redemption and on the NBFCs, which brought pressure to the money markets and to the debt markets. Then there was deleveraging in the equity markets, as happened around the world. That put pressure on the equity market, and as FIIs took the money out, it put pressure on the foreign exchange market. On top of all this, we in the Reserve Bank, we were intervening in the market because we wanted to provide dollar liquidity. As we were providing dollar liquidity, we were sucking out rupee liquidity, and that caused additional problem. The corporates too, they were accessing credit from the domestic banks and financial institutions, and for their foreign exchange market were asking for foreign exchange, which put further pressure on the foreign exchange. So the short point is all our markets, debt markets, money markets, equity markets, foreign exchange market, all of them had come under pressure. The second channel for the spread of the contagion was the real channel, and the transmission of external shocks to domestic vulnerabilities is quite straightforward. There was slump in demand for exports. The services exports, on which India had grown to depend, they had decelerated. And at the depth of the crisis, we were even concerned that remittances, which were the backbone of our invisible account in the balance of payments, they might decline, but in the event they did not. The growth was somewhat subdued last year, but this year it's picked up once again, so remittances were not affected. The third transmission channel was the confidence channel. I want to say that in sharp contrast to what is happening around the world, financial markets in India continued to function normally after the first 1 week of hiccups. But even so, when Indian financial institutions saw the liquidity crunch in the global system, they didn't know what was happening and they were uncertain. Therefore, there was some risk aversion, there was some caution. They held back lending, which again caused some problem, mainly because of the confidence channel, and that persisted for about 6 months after September 2008. So again, in response to the second question, how was India hit by the crisis? We were hit by through all the three channels that in fact affected other emerging economies. Now let me move to the third question, how did we respond to the crisis? Both the government and the Reserve Bank coordinated. The government came out with 3 packages of fiscal stimulus, and the Reserve Bank had provided monetary accommodation, and we'd also taken some countercyclical regulatory measures. For the RBI, we were guided by two priorities. First, that the money and credit markets must continue to function normally. And second, that whatever liquidity problems might be there, they should not develop into solvency cascades. So, three things we drove. First, that we will maintain ample rupee liquidity. We will maintain a comfortable foreign exchange liquidity, and we will ensure that credit continues to flow to productive sectors. And how did we do that? Again, through conventional and unconventional measures. Now, I don't want to go into details, but these were the standard measures around the world, and they were standard measures in India too. The government again came with three packages of fiscal stimulus. There were questions about whether India's government should have resorted to a fiscal stimulus of this order because with a lot of difficulty, we'd gone on the process of fiscal adjustment, of fiscal responsibility over several years before the crisis. There were concerns, anxiety about whether we were retracing all that. But in the event, I think it was necessary for the government to come up with countercyclical expenditure measures given the depth and extraordinary nature of this crisis. Let me spend a minute on explaining our response to the crisis. We were criticized, the Reserve Bank, for not being bold enough, being behind the curve, being reactive rather than being proactive, being incremental, guarded rather than being bold. I'm saying this not so much as a defense, but as an explanation, which is that even as the origins of the crisis across the world were common, the way they transmitted in advanced countries and in emerging economies was different. In advanced economies, the adverse feedback loop ran from the financial sector to the real sector. In emerging economies like India, the feedback loop was from the real sector to the financial sector. Advanced economies were fighting a financial turmoil and were fighting what seemed to be a deep recession. We, in turn, were actually concerned about arresting moderation to growth. So in the Reserve Bank, there was a lot of debate about whether we should be aggressive or whether we should be incremental, unguarded. My own sense during that time was that it is more important to be seen to be doing something periodically rather than do one big step and keep quiet. And people are concerned about what is the Reserve Bank doing, have they gone off to sleep? So it was very important that we made our presence felt each point of time. So I believe what we did was actually crossing the river by filling the stones, incrementally easing our policy. I've answered the first three questions. Why was India hit by the crisis? How were we hit? And how did we respond? Let me now turn to the more important question about what is the outlook for India. On the outlook, growth is getting consolidated and getting more broad-based. As I said, for the fiscal year that just ended, the official estimate is 7.2%. I believe a number will come early in the first week of May. But now people are saying that it might be slightly higher than 7.2%. There is some concern, although not as much as in advanced economies, about whether withdrawal of fiscal and monetary stimulus will impair growth impulses. We've looked at the numbers. There is other drivers of growth, private consumption, private investment are picking up, but not sufficiently as yet. So we need to be quite calibrated about how we exit from the expansionary fiscal and monetary policies. So the first point, growth is consolidating and getting more broad-based. Second, agriculture was hit mainly by the monsoon failure last season, the southwest monsoon, June-September 2009 was hit. Rainfall was 27% below normal. Third, industrial growth is picking up momentum. Numbers have been coming and they're quite robust actually. Industrial growth year on year for the last 3 months has not only been higher than the pre-crisis level, but has been the highest in the last 20 years. So industrial growth is quite robust. Capacity utilization is now 80%. The cyclical peak, I'm told, is 85%, so we're quite close to the peak of capacity utilization. Exports have picked up, notwithstanding the appreciation of the rupee. They declined for 11 months during the crisis, but they've now started on the positive growth track. Imports too have contracted, but they picked up again. Investment intentions are strong. If you look at how the capital goods sector is growing, that's growing in double digits. Actually, in 1 month, it recorded growth of 56%, which is a very strong demonstration of the investment intentions. Domestic and external financing conditions have improved. Credit growth in the just completed year 2009-10 was significantly higher than what even the Reserve Bank had estimated as recently as in January. In 3 months, credit growth has really picked up. Even external financing has opened up. And there is a resurgence of positive sentiment. We do a survey of business expectations, outlook, etc. And those survey results are quite heartwarming, actually. On the outlook, the big worry, though, is about inflation. In the recent period, that's been the big story. Inflation, as we measure by the wholesale price index, WPI, that was negative as recently as in August 2009, in a 6-month period that had gone from negative to nearly 10% in March 2010. Consumer price inflation, we have 4 CPI, 4 indices. All of them have remained, even when WPI was negative, consumer indices had remained above 15%. They're still quite stubborn in the 15-17% range. Even though this episode of inflation started as one driven by supply-side pressures engendered by the poor monsoon, recent evidence is that inflation is getting more generalized and that demand-side pressures are building up. How do we say that? We don't have a measure of core inflation like in advanced economies, but if you take non-food manufacturing, which is our closest measure of core inflation, that was negative 0.4% in November 2009. It's now 4.7%. Fuel inflation, that was negative 0.8% in November 2009. It's now 12.7%. Contribution of non-food items to inflation, that was 0 in November. It's now more than 50%. So all these numbers show that demand-side pressures are building up. And why is that happening? That's happening for a number of reasons. In the recent budget, the finance minister had withdrawn the excise concessions given as part of the fiscal stimulus. That's pushed up prices. They had slapped additional customs and excise on crude, I think quite rightly, but that's pushed up oil prices. There's been increase in prices of some of the important inputs, administered prices of coal, also prices of steel, etc. have gone up. And surprisingly, there's wage pressure. The stereotype view is that India has shortage of skilled labor, which is correct, but evidence of the recent period shows that even unskilled labor wages have gone up. Actually, there's a silver lining to that, which for a long time, for 25 years, people like Swaminathan Iyer have written about it. There's been a huge governance problem in India in implementing social safety net programs, the amount of leakage there was. But recent evidence shows that there's been a remarkable improvement in that because of improvement in governance, because of improvement in accountability mechanisms. The NREGA, the Rural Employment Guarantee Program that worked during the slowdown period. So there is there's money there, that people are having money, and people who used to travel for work, labor, who used to migrate to work, they've stopped migrating so much because there is work in their villages. That's pushed up wages, even in the unskilled category. And finally, if capital flows resume, I'll come to the issue of capital flows a little later, but on the inflation side, if capital flows resume and we intervene in the foreign exchange market, for whatever reason, I'm not suggesting that we will, but if we do, there will be pressures on the liquidity side, and that will put further pressure on inflation. Asset prices have been building up. The equity market increased by 90% in 2009-10. Gold prices are at an all-time high. The only people who are happy about gold prices going up in India is the Reserve Bank. As you know, we bought 200 tons. Okay. Real estate prices in cities like Mumbai, they've exceeded the pre-crisis level. So asset prices are picking up rapidly. And finally, I want to allude to some comments about structural inflation in India. Some people have told me that they said, look, don't think inflation is going to come down to 5-6% very soon, because there's a structural component. As I said, people are eating better, quality of life in rural areas has improved, people are shifting from cereals to protein, vegetables, milk, eggs, etc. So that's going to push up inflation from the structural side, and it'll take some years, not months, some years for the supply side to catch up. So in India, you have to be reconciled to higher levels of inflation. I don't know enough to take a view on that, but that's an issue out there. So the big picture is that growth is consolidating and getting broad-based. Supply side inflation pressures are abating, but only gradually. And meanwhile, demand side inflation pressures are building up. The challenge for the Reserve Bank is to manage the growth inflation dynamics going forward. And what did we do? We've been talking about exiting from the expansionary stance much before other economies. And indeed, because of our own growth inflation situation, we had to exit sooner than most other countries. In fact, it's interesting that we do a quarterly policy review. And one was end of January. The next one was a week ago, actually, last Tuesday. But we had raised rates in the mid-cycle period on the 19th of March. Before us, Israel had raised rates, Australia had, Norway had, I can't recall any other country. And it was accepted. Australia is a commodity exporter. When they raised rates, that did not attract comment. It attracted notice, but it did not attract comment. But when we raised rates for the first time on March 19, we did that on Friday evening after our markets closed, because that's what we do. We look at our markets and did that. But within 15 minutes, I saw a ticker that the Dow had reacted to India's increase of policy rates, because they had seen India withdrawing from expansion as a signal of the beginning of G20 withdrawal or whatever. But I was somewhat struck by that development. So what did we do? We started unwinding in October 2009, actually. We terminated the unconventional measures first. We raised the SLR, which is a liquidity requirement unique to a few countries, including India. We raised that, brought it back to the pre-crisis level. We raised the CRR, which is a cash reserve requirement on the banks. We raised that by 75 basis points end of January, and by another 25 basis points last week. And we raised the policy rates once mid-March, once again last week, by a total of 50 basis points on the repo, on the reverse repo side. The details are not important, but what the message you must get is that we have begun in earnest the process of reversing from the expansionary stance. What are the dilemmas for us as we exit from the monetary stimulus? First, how do we calibrate the unwinding? Getting into the expansionary stance was relatively simple, even for somebody getting into a central bank cold like me. It was quite simple because what needed to be done was quite clear. What you did at each point of time was not so important as much as that you were doing something. So there was the tolerance for error was relatively more. But as we exit out of the crisis, I have realized that you've got to be much more calibrated because the implications of what you do, and if you get it wrong, can be quite big. Second, how do we prevent a hard landing? Some people have criticized us for withdrawing in gradual steps. The argument is like this. They say that, look, demand-side pressures are catching up. Monetary policy has a lag of 12 to 24 months. So look forward 12 to 24 months. You should be acting now. You should be more aggressively raising rates. That's the first argument. The second argument they put forward is this, that, look, if you're raising rates gradually, people are uncertain about what to expect. They'll keep on expecting you to do it for several months. So just get it done and send a signal that, look, you're done with your business so that people can factor you in and move on with their business decisions. Okay. But our response to that has been that, yes, we must act to contain demand-side pressures, but more importantly, the way to do that is to encourage investment so that supply keeps ahead of demand. And that's the rationale behind our gradual move towards unwinding the stimulus. The third issue is about giving forward guidance. That's a big issue in central banks, a big issue here in America, I know, and for us too. People have said that, there's a neutral rate, so you let the market know when you're going to get to that neutral rate. First of all, I'm not sure that the concept of a neutral rate is applicable to India. No, a neutral rate is one, I'm told, which is consistent with the potential growth rate and low and stable inflation. That's applicable to advanced economies. It's not clear that for an economy like India, which has such huge growth potential, demographics, efficiency and productivity improvement potential there, that there is a concept such as a neutral rate. However, the IMF, Kalpana and her team have done a study of what could be a neutral rate for us, and they said back in January that it's something like our rate was 200 basis points below a neutral rate. So I back calculated that comes to about 5.25. So if you put the 75 basis points on either side, the neutral range is for 4.5 to 6%. You can look at it another way, which is that when we were in the boom period, or in the economy was said to be overheating, the policy rate was 9%. In the depth of the crisis, we brought it down on the repo side to 4.75%. So if you do a rough back of the envelope calculation, it's somewhere there. But regardless of what the neutral rate is, the question is, should we give guidance and should we tell them when we're going to do our business? And that is a dilemma. Okay. And finally, there is this question about reversal of monetary accommodation. Is that anti-growth? On that, my response, my view is quite clear. In the short term, in the near term, perhaps it could be anti-growth. There is certainly a sacrifice ratio there. But even in the long term or in the medium term, sustained inflation is inimical to growth. So we've got to get inflation under control. I'm not even sure that in the short term there is a trade-off, because if investment continues, because people take investment decisions not based on today's macroeconomic situation, but on macroeconomic situation going forward several years, I'm not sure that investment is going to be hit just because Reserve Bank raises rates. So on that, the response is that withdrawal of the stimulus is in the best interest of the economy, and it's not certainly anti-growth. Based on our view of the macroeconomic outlook, the Reserve Bank projected last week that growth for the year 2010-11, starting from 1st April 2010 to 31 March 2011, will be 8% plus, which means that it won't go below 8%, but how much above 8% is a question. WPI inflation, we believe it will be about 5.5% by the end of March. But again, as Groucho Marx said, never make a prediction, especially about the future. But in the Reserve Bank, we have to make predictions. 5.5% is, we'll have some advantage of the base effect, because inflation last year was quite high at that time. We will have base effect comfort, but I'm hoping that even on an average basis, inflation will come down and settle around 5.5%. What are the risks to the growth inflation outlook? First, if the global recovery stalls, it could have an impact for us, notwithstanding the fact that India's external sector is in relative terms small, because it will affect trade, of course, it will affect financial flows, of course, but even sentiment will be hurt, as experience has shown. Second, global commodity prices, if they spike, it will have impact on us. IMF, I think, said that the oil prices will be range-bound around $80 for March of 2010. We're already seeing that they've gone up to $84, and the short-term outlook, even the short-term outlook, is not quite clear. And India being a major importer of oil, we will be affected if oil prices spike. Third, and a big issue, is a poor monsoon, another poor monsoon. The law of averages works over a period of time. It doesn't work on a 2-year period, which means that monsoon is not serially correlated. Just because we had poor monsoon last year, it's not guaranteed that this year it will be good. I'm hoping that it will be good. If we have a deficient monsoon, it will have impact on the inflation side. It will have impact on the growth side because of rural demand and rural investment consumption. And importantly, it will have impact through the fiscal burden if government has to come up with some social safety measures that will have additional burden on the fisc. Fourth concern is about capital flows beyond our absorptive capacity. The rupee appreciated by 12% in 2009-10 and by about 18% in real terms because of the inflation differential. Even so, exports have picked up because we're seeing on a year-on-year basis, so they're picked up, but appreciation is going to hurt the prospects for exports. And if capital flows come in, and depending on how we manage them, if at all we manage them, there will be concerns about inflation, about interest rates going up. And finally, there's concern about overheating and hard landing that I had already alluded to. Okay. So the task in macroeconomic management in the short term, how do we restore the economy to the trend growth rate without compromising price stability? And in the medium term, how do we in fact raise the trend growth rate? I have some more material, but I will stop at this point and take questions. Is that okay?
Sure. Okay, thank you very much.